Okay, very good morning, guys. And I literally cannot believe what these charts are telling me and what the people of Great Britain have voted for. But let's face this and look at this objectively. It's happened, and first of all, how did the market move? Well, where do we stand at the moment? Well, I said to myself that I would stay up to see the initial kind of volatility that I thought we might see at around 10 o'clock when there was some polls coming out. There was a YouGov poll that was released by Sky News pretty much immediately, and then I wanted to see just the first few come in to kind of verify not just my thinking. The way the market was priced was that this was a pretty much done deal, that we were going to remain, and so I just wanted that to be to see the first few, cement that, and then wake up this morning, get in early to see that continuity has prevailed. But literally quite the opposite. I'm literally watching Sky News right now, looking at number 10, waiting for Cameron to come out with a potential resignation with immediate effect. So how this unfolded then, we actually gapped up at the reopening of sterling futures. And that came after, as I say, the YouGov poll came out. It was not an exit poll, but a poll conducted on the day, and that showed still a slight marginal victory to remain. And then Nigel Farage came out pretty quickly and pretty much conceded defeat. Although he did retract that, go back and forth a couple times, classic Nige action. But we actually moved up to 150 initially. But then you can see the first kind of slide here. Let me get this move here that I'm showing with you. This was when two real big northeast areas came out. Sunderland we knew was going to be important, just given it was one of the real kind of strongholds, if you like, of the push to leave. And it surprised because the actual number was much larger to leave than was projected. That coupled with Newcastle came out just before Sunderland as well. That was more against what the market had been expecting for these particular areas. Newcastle, I think, was slightly remained, but the gap was much narrower than was expected. Then we had the Sunderland come out, so we had the first big wave lower. We saw then a pretty significant bounce, and at that point I was still pretty confident that the Remain would prevail, because at that point no one in London or no borough of London had voted. When you think about it, Sunderland's vote in total was only around 120,000, whereas, let's say, the borough of Wandsworth is almost double that size. And so at that point we had a bounce. I think people were thinking the same, that these were only like the first 10 that had come in, and it was pretty slow going actually. They didn't start coming in thick and fast until, I guess, 2:30 onwards. The next kind of flush lower, though, came with Swansea. Now that was a big surprise, because it was totally against what was expected. We were looking at a fairly comfortable Remain, and it came out with a severe or a large percentage gap to leave. And then you got that second push lower. Again, volatility, the movements were hugely exacerbated by the state of liquidity as well. The price action that you were seeing, even with these two areas I've identified here, this was already the second biggest intraday move in sterling in the FX markets. And when we're looking at it now, if I just get a percentage on this, from 150 where we were down to the lows, that's 11.65%. The pound has fallen. Now it's found a bit of support around 132, and that was actually in fitting what some of the banks were calling for. Obviously a much more violent move to the downside than potential relief rally, given the fact that we were priced for Remain. So with this down now 11.6% at the low, that is the biggest downside move ever for the sterling currency. So this is unprecedented, what you're seeing this morning. The interesting thing, though, since we've come in, sterling has seen a bit of a rally. and it's not been on the back of any new news, but I think this is more to do with profit taking. As I said, the previous largest move, I believe, that sterling's ever seen on an intraday was about 6.5%. We've doubled that overnight. So with that kind of size of move, I think it's fairly understandable to see a bit of a pullback this morning. You know, the most bizarre world that we're living in this morning, Will's biggest trade has been to long sterling off these lows. Incredible. It's you know, the way that the market is moving. So what happens from now? Well, we've got 1 minute now to the Eurex Open. So I'm going to just reduce this chart. We'll have a look just as the markets open, see how they react, and then we'll go into what this means and what we're looking for from here forward. Let me just change this over to a DAX chart. You can already see here in my 10-minute or T-note, we're up 3 points already. The basis being then, in summary, we'll go into more detail, but a US Fed hike. See you later. It is not going to happen anytime soon. Certainly not this year. Possibly not even next year. You know, we're looking 2018, 2019 for kind of next rate hikes. Most people are now expecting the Bank of England to cut rates this summer now. That's the state of play. But let's see how the market's open. Let me, I've got DAX in the top right-hand corner.
Fucking hell.
That's the DAX. That's the DAX opening up there. You can see we've gone through 9,400 at the open. Let me change this to the Bund.
That's a 10% gap.
That's a 10% gap lower for the DAX at opening a market here. Looks like we're still waiting for the Bund. It's quite normal that there's a delay given the size of the gap that's likely to be seen at the open. The DAX though, again, look at that DAX open, incredible. Yeah, we're looking at losses of over 10% in the DAX this morning. Okay, so next things then to look out for. Quick run through of state of play and what this means. First of all, Sky News, again, David Cameron is really critical now on what he does. Now that this unexpected event has happened, most likely is he's going to have to resign. If he resigns, George Osborne also goes. Problem is, in terms of political stability, who runs the country? Gove and Boris?
And Nigel.
Does Nige get involved with a key seat at the table? Or does Corbyn take control? Like, every single scenario scares me to death. And from an investment, in foreign investment point of view, from a negotiation with Europe point of view, how on earth is that going to go down? Another thing on the back of this is, if Cameron does go, which I think will likely have to be the case now, who exactly is going to negotiate a deal with Europe? Cameron had a very good relationship with the biggest power in Europe, which was Angela Merkel. Not only Europe, she is not going to be happy with this state of play. And if you're Europe, what would you want to do? You'd want to stop contagion happening with other countries, potentially getting a bit of confidence in the back of this Brexit going through. So what would I do in negotiations? I would make it absolutely terrible conditions on those terms to Great Britain, because then it would scare the life out of the likes of other countries trying to do the same. You have to make now a martyr of the UK, in my opinion, if you're Europe, in order to stop the rot of other countries potentially doing the same. That, of course, is a huge negative to the UK economy. Already, you've had articles this morning. S&P, the biggest of the three major sovereign rating agencies. Let's not forget, S&P is the only credit agency that has UK still at AAA. That's about to change. The UK government will be informed in the next 24 hours on their decision, but they've already said it's likely we will lose that AAA credit rating. Now, these are important things from a country that is heavily dependent on inflows. Just looking at a couple of the banknotes this morning, Deutsche Bank also makes some very interesting points. If Cameron does resign, announce his resignation, which I think I'm going to be expecting this morning, it will likely take some months before a new leader is elected. As I've said, there is no real succession plan here because this was not really planned to happen. There's literally probably offices around London with the champagne ready to pop, and it's just gone completely wrong for them. In terms of timings and when a replacement could come around, a new leader could try to be installed ahead of the party conference. That's the Conservative Party conference. That's not due until October. So just think about it. We could be in a political state of uncertainty for at least the next 3 to 4 months. The next key point, of course, is when we as a country decide to exit. That gets formalised when we trigger Article 50 of the Lisbon Treaty. That's when you basically hit the stopwatch and your 2-year negotiation period begins. Obviously, we need to get our house in order politically before when we'll probably push the trigger on that. In terms of what some of the banks are saying, Deutsche Bank then, they expect UK GDP growth now to be 0.9% next year. That's 1.2% lower than what it would have been in a Remain scenario. The euro area is going to be affected to the tune of negative 0.4 percentage point, and global growth is going to slow by 0.2 percentage point. Again, this is the domino effect that this is going to have across all of the other central banks and global activity. What does it mean then for the Bank of England? Well, as I said briefly, looking at the Treasury market, just off the highs, but we're up around 3 points already. If you were to rewind about 4 or 5 weeks ago, we were asking ourselves, are we going to see a June rate hike? Can you imagine if the Fed hiked rates in June? And now this has happened. Thank goodness they did not do that, and they put a large amount of emphasis on this referendum, because now rates are not going to rise in the US for the considerable time. In terms of the Bank of England, I've already read this morning some investment banks are calling for the Bank of England will likely cut interest rates 25 basis points in August in response to a weaker economic activity. The argument here is that although the pound has weakened substantially, and that should raise prices in terms of an inflationary perspective, the Bank of England's probably going to focus more on the dire state of economic growth and activity, and therefore have to cut rates. Not only will they likely cut rates in August, they could cut it again in September, and they could also push the button again on the QE and resume that in September. Other things then to look at, the knock-on effects of this. Scotland as a nation vote to remain in the EU, then it would likely push for another referendum with the associated increase in political and economic uncertainty. Financial sectors would likely suffer to the extent that banks with head offices and subsidiaries in London would be unable to passport their businesses around Europe. And let's not forget as well, from a political point of view, the Spanish elections are this weekend. So, Will said it this morning, if you weren't into politics before, you're damn sure going to have to get into it now, because this is now going to be the headline story. The financial markets and the movements we're likely to see over the next coming weeks, months to come, this will now be front page news. A couple of bank calls on estimates for sterling in terms of cable. I've seen HSBC this morning, they said cable, they look for a fall to 125 by the end of Q3 and then 120 by the end of 2016 as the uncertainty lingers for the rest of the year. Certainly in the context of the political uncertainty we're going to see, if Cameron does in fact resign, then I think that's a strong possibility, if not lower potentially for cable. And then they've also lowered their euro-dollar forecast as well on the fact of contagion. Again, in terms of countries, most negative perceptions of the EU, so ones to potentially watch for problems that this could now cause for those also looking, is Brexit is likely going to be another word that's going to crop up again. Cyprus, Austria and the Czech Republic are also seen as other potential candidates to cause further headache. The other part of this is market psychology. If you think about it, the surpriseness of this result, the unpredictability of the political process, is going to pose a massive barrier, I think, on the market's self-confidence, its ability and willingness to take on risk. It has got severely burnt in calling this wrong, and as such, that's only, I think, going to add to more of the negativity and the sentiment as we go forward. One of the guys in the live room asking about could there be a push to a second referendum. Well, talking off the top of my head, just remembering some of the research heading into this, if, as I've been saying, the picture is as dire and as a dark a future as I say, potentially then the UK has a massive downturn. Let's say hypothetically we fall into recession again, then certainly if the conditions got worse enough, then there might be a complete political crisis or faith in the government, and it could force the public to push for yet another second referendum. If you remember that chart that I showed you before, well, let's just get it up, because I think it's definitely valid in this scenario this morning. Just give me 1 second. Okay, here we go. So this was Credit Suisse. If you remember, Credit Suisse said that even if we voted to leave in this referendum, there was only a 70% chance that actually we would exit the EU. Now, looking at the chart then, vote to leave, that's happened. The next key part, what does Cameron do? Does he resign or does he stay? That then will resolve the who is going to lead the Conservative Party. That will then either lead to a period into the next general election, or it will lead to a pro-Brexit government. Negotiations with the EU terms begin, and the most simplest way would be then we leave. The problem is, though, is all this on the right-hand side, because negotiations with the EU terms of leave, they go badly on the leave terms, sent to then a second referendum for, or let's say Europe has to negotiate a new plan with the UK. The UK then has to take on board what it is that they're being given by Europe. We then, the people, in a democratic society, need to say, do we agree with that? And so likelihood then we have a second referendum. Does the political situation then and the dire state of the economy mean that people are very much less inclined, having seen the actual impact on the market and people's lives, that they then vote to say, well, no, we actually don't want to leave? And then that leads to a pro-Remain government scenario, a second full-on referendum after the referendum on the terms of negotiations, and then we actually remain. So in the long run, there certainly isn't a completely done deal. The negotiation process, as we know, is going to take many years, possibly, but near term, intraday, looking at the charts as they stand at the moment, I think you're seeing a bit of a bout of profit taking generally in the pound from these most depressed levels. I guess 140 looks like a suitable level to the upside here. I mean, it's 2 points off where we trade at the moment, but believe me, 2 points is nothing in these conditions, and 140 was kind of a bit of a marker in the sand, if you like, for support before we saw the big flush lower when around 50% of the actual local authorities were known overnight. So I'd be looking at that level, but ultimately the prevailing trend will be lower for sterling. The DAX already, as we've seen, is down in excess of 10%. I'd be looking at things like Italian bonds, bank financials in particular are likely to get hit the hardest. I'd be expecting peripheral bond spreads to be widening as the contagion effect really takes a grip on the market. Potentially when the US come in, it will be interesting to see how they react. Obviously the fact that US rate rises are going to be pushed back at least, I would say, a minimum of 2 years at this point. So keep an eye on timings when the US come in as well. I think today's trend, it will be interesting to see if we have a little bit of a pullback now. Don't forget, much of the institutional moves would have happened overnight. And then we get another flush lower potentially when the US come in, and with the bigger trend being now more negativity across UK, European assets, leading to a broader flight to quality. Okay, going to leave it at that. We're going to be on the mic throughout the day. Good luck out there. Be careful with these moves. You're going to see price movement like you've never seen before in terms of a trading range. So keep that in mind. Okay guys, thank you.